What's happening, Hardscapers? This is episode 292 of the How to Hardscape podcast. We talk about how you can start and grow your hardscaping business. And on today's episode, we have a Cycle CPA takeover episode. Joseph Policastro talks about cash leaks and how these will affect your cash flow in your business. A lot of great aspects of these cash leaks in your business and how you can go ahead and plug them. We want to say thank you to Cycle CPA for sponsoring the How to Hardscape podcast. And if you're looking for bookkeeping, accounting, CFO services, reach out to Cycle CPA at cyclecpa.com. Let them know How to Hardscape sent you for money off their services there. They also have the Green Industry Profits podcast, which I recommend subscribing to, and a very great Facebook group, Landscaping Accountant, on Facebook, as well as checking them out on their Instagram page, cycle_CPA, because they're always posting some really good information on all of those platforms. But all those will be in the show notes as well for you. And without further ado, let's get into today's episode with Cycle CPA.
Hey everyone, excited to dive into this episode here as we start off 2025. I know a lot of you have exciting plans, that you're budgeting it out for, and really trying to hit your goals this year. And I know that there's a lot of the items, especially when you're looking at even your profit and loss or your budget, and you're planning out for this year, that are in regard to revenue growth or some of those more talked about items. But I think it's also important to focus on some of the aspects of your company that could actually be leading to cash leaking out of your company, right? Or some of those things that you may not think about as much when it comes to making your company as financially healthy as possible. And to kind of kick this off, I think one of the things is considering opportunity cost, right? So sometimes doing an activity within your company that is maybe the cheapest option, or maybe not doing something because it's more cost effective, may not actually be the best move in the long term, especially when you look at it from an opportunity cost perspective. And an example of this is maybe if you look at investing in better equipment or hiring key staff and making that investment, investing into education for your team, utilizing the right technology and software. So even if you look at an example, maybe even marketing, right? So for a company that just does word of mouth marketing, sure, they're not spending any money on marketing funds, but what is the opportunity cost of not spending money on marketing, not investing into that growth? Right? A company that then invests into marketing is able to actually increase revenue and profitability, right? So it's always important to also look at and understand that when you're looking at expenses, that there's a difference between some of your costs that you can probably look to decrease, maybe like utilities or telecom or disposal costs, right? You're really looking for just the lowest cost options there. But the other side of it, there are certain items within your company that you also want to look at from an ROI perspective too, right? So try to always keep that in mind when you're assessing some of your costs. Another thing is also missed opportunities, right? So, when you're looking at things, whether it's working with specific subcontractors and having those relationships in the community, also thinking about upselling and cross-selling services, right? So when you're looking at upsells, you're not having to spend the same funds on marketing, right? You're not having to even go to an additional property, right? Sometimes you can even knock it out and while doing the same service or the original service that you're already performing. So it doesn't add to some of that idle time and travel time as well. So much of that actually goes right to your bottom line, right? So when you're thinking about ways to optimize cash flow and even try to prevent some cash leaks within the company, definitely thinking about what are those opportunities out there, right? And making sure that you're taking advantage of those as much as you can, especially when you're looking at starting with your existing customers and existing relationships, right? And really trying to optimize those, first. And then when you kind of take a step back and look at cash flow, also understanding that, yes, it's nice to look at some of your expenses and revenues and a profit and loss statement, but but also looking at your balance sheet items, right? So whether you're purchasing equipment and trucks or whether you have debt payments, right? I know this year, when we look at the green industry as a whole, the average net profit was closer to around 6%. The average net cash flow was closer to 0%, right? So where are those areas that we can really focus on? And what we recommend and what's even in our reporting is looking at that more in a trend basis, right? And more in a graph format month after month. So that way you can really diagnose what months were an ideal last year and how can you improve that for this year. An example of that is, we work with a client where in the previous years they had to use a line of credit for 4 years throughout the winter. And then each year for the next couple of years, we were able to basically narrow that down to then using it only for 3 months and then 2 months, right? So always trying to look for, what are those incremental improvements you can make within the company as well. And something that can also impact cash flow is assets, right? And so are the jobs that you're getting, are they the right jobs based on the equipment that your company has, right? If you're not working on the right kind of jobs based on the assets that you have, that's going to cause, you know, for you to not make the cash flow that you can make. Also looking at things like are your employees tasks lined up with their pay rate, right? So if you have managerial or upper level employees working on some of the lower level tasks, those are areas where, that's actually leaking cash, right? You can really, instead try to match whatever you're paying employees with those given tasks, right? Um, or even another example is, you know, having managerial people drive too much, right? Or maybe go pick up material, right? Trying to really really think about stuff like that because again, it is something that is relatively hidden. You're not necessarily going to look at that in a profit and loss statement, knowing that okay, and it also applies to a lower level employee should not be doing some of those higher level tasks because they're probably not going to do it well because they're just not trained to that capability yet. So really trying to think about again, do you have the right assets for the job? Do you have the right people for the job, both in the field and administratively? And going back to the assets, right? Are you utilizing your assets well? What is the utilization rate? Is it 60%, 70%? A low utilization rate with your assets typically indicates that you have a low return on your fixed assets as well. And factors affecting utilization could be things like seasonality, right? What are the seasonal variations? Can you only use that equipment during a specific time of year? That's gonna put you in not as strong as a position as someone else who can utilize that throughout the year. Also, do you operate a company where you have 5 different service lines and each service line has a different piece of equipment, but you don't necessarily use those equipment as much as possible because it's not as up to capacity with each of those divisions? An example of that is looking at a $2 million company. They provide just maintenance and they have mowers and they operate throughout the year. And another company that purchases a skid steer and does maybe a lot of maintenance, but they don't really do enough jobs to really warrant the use of that skid steer, right? So really understanding, okay, are we utilizing our equipment? Also, a huge thing is maintenance and downtime, right? Not just the amount of time that you can't use the asset, but think about the funds that you're actually losing that you could be making instead. Especially when you're paying your employees to work in the field and work on the projects, because when it comes down to it, that's really the biggest priority. You want to do everything possible to make sure that your crews are continuing to work in the field. Any downtime has a big impact on the cash flow of the company. And then also always looking for ways to optimize and make your operations more efficient. And when you're looking to make certain decisions within the company, especially when it comes to maybe like asset purchases, understanding that you don't just look at the tax perspective. You don't just purchase something because it's going to lower tax liability. Also, keeping into account the whole perspective of okay, what is that return on your fixed assets, right? So understanding that okay, there could be company A and company B. Company A has the same amount of assets and makes lower profit versus the other company has the same amount of assets and makes a higher profit, right? You're basically looking at it where, that first company that I mentioned, they can then spend that money instead of putting it to fixed assets, they can put it more into growth and other things to help grow in a more strategic way. So again, it's those things that you don't necessarily see as clearly. Um, Sometimes when you're looking at your financials, but there is a cost to that, right? And it's something that we definitely urge you to kind of look into a little bit deeper. Another example of something that's relatively hidden is, yeah, you might see that your overhead is excessive, right? But on the other side of it, if your overhead is too lean, so a lot of those back end costs, that can actually be a negative thing as well, right? So that can actually cause high employee turnover, right? Because you don't have the right resources and the right people or the amount of people to be able to handle and support the main operation, which leads to burnout, right? Leads to people not keeping up with the quality and meeting, customer satisfaction. Also could lead to increased errors and quality issues. And ultimately, it's a lot harder to support growth if your overhead is too lean as well, right? And using industry averages as a barometer, typically low 30s percentage wise out of revenue is typically around what the average looks like. And we also recommend to companies look at it, don't get too overwhelmed, right? Just try to approach different line items and try to do what you can to, maybe decrease it over time as well. Another kind of hidden item is non-billable time, right? So, what are some of those areas, right, where maybe there's idle time or, in different opportunities where you can really increase the amount of, time that your employees are working on jobs, right, instead of doing other ancillary activities. So what we recommend for this is things like time blocking, right? So that helps to prioritize work. It helps to avoid distractions. Also tracking progress and making sure to set boundaries with that, right? Looking at things like route efficiency, right? For those companies that do a little bit more of that maintenance or reoccurring service. The tighter the route density, the less non-billable time there is going to be ultimately. Also, making sure to improve communication and standardize processes as much as possible, right? The less confusion that goes on, the more people are going to be working on the jobs, right? So, making sure it's always, what I say is always to over communicate. And then even on the administrative side, right? Can you outsource specific tasks to limit in-house training time as well, right? So looking at all of those different opportunities to kind of take advantage of. And maybe there's even some items within the field that your team is not as efficient with, right? Or maybe it just always requires a little bit more training, right? Is it better than to work with a subcontractor, right? A more specialized subcontractor for that specific item. These are all things that can really limit your non-billable time. Another relatively hidden item is when you're looking at your labor projections, right? So understanding that your revenue per employee is something that should be monitored as well. So you might realize that, okay, if I'm going to be at 1 million in revenue or 2 million in revenue, how many employees are going to be needed in order to support that, right? In order to kind of break even and then make a profit. Um, and if you're at a low revenue per employee, right? So that's something that is not going to put you kind of in the driver's seat and more in the offensive mode. When it comes to growth as well. Another big thing that could be leading to some of the cash leaks is training costs, right? So, um, training a new employee is time intensive, and ultimately, I think what we say is always try to pour a lot into just employee retention, and ineffective training really causes increased accidents, reduced productivity, increased customer complaints, and increased turnover, right? So this is a big thing. Do what you can that's in your control. in regard to this aspect of things. And it's good to always give a good first impression to not only when you're working with clients, but even when you're onboarding employees, right? And during that experience, it's a, it's a very underrated aspect of, of the, uh, of the profession. Also looking at seasonal challenges, right? So plan ahead of time, right? Always, don't plan as it's already happening, right? Always try to, when you're building out a budget or a forecast or just meeting with your team on a quarterly basis, always try to look ahead, right? Assess, okay, what happened in the past and how can we improve for that? And a big part of that, especially from a seasonal perspective, is tracking your fixed expenses, right? So there can definitely be some cash leaks just because when you made some of those fixed asset purchases, or I'm sorry, fixed expense purchases, you were thinking it more in terms of how you were gonna be able to recoup that during your busier time, right? But ultimately think about some of those items even when you're in the slow time, even if you're not, in the winter or whenever your slower time is, really always kind of take that hesitation before you make any sort of purchase that's going to be more of a fixed cost, right? That's going to be kind of relatively the same throughout the year, which basically won't vary even if some of your work volume decreases. Also, making sure to build up a cash reserve, right? Because the reality of business is that there's always going to be some sort of cash leaking out of the company, right? Especially for a company that's growing faster. But building up that cash reserve is going to be crucial for a couple of reasons, right? It's going to give you that peace of mind and allow you to take advantage of different opportunities that come up, whether it's to maybe acquire another company or just kind of be able to think more into the future and really try to improve the company instead of being more in that defensive position as well. Also, are there additional services you could take advantage of and be implementing as well? And of course, I think it's always best to stay conservative with the snow services and the expectations there, right? Don't rely overly with that, because that's where we see, especially working hard throughout the summer. We hate to see the profits then dwindle or basically leave the company during the winter, right? So really building out that year-long budget so you can really capture all of those fixed costs as well, and don't overestimate when it comes to the snow revenue as well. Um, and then even things like inflation. I mean, I think that was a very it was a talked about item the past couple of years, um, and really understand, okay, what are some of those pass through costs that really you want to try to pass on as much of that cost increase over to the customer. And it's not just in cases where inflation is excessively high, right? It's always thinking about, okay, doing at least a yearly price increase, because ultimately you're going to want to give those pay increases to your employees, and and provide them with a great place to work, and be able to offer different additional benefits there, right? But it starts with making sure that you're passing on some of these increases over to the customer. And even in regard to cash reserve, right? Instead of having an excess amount in your bank, when you have inflation, it's something where the value of that is actually going down. So making sure that you're taking advantage of certain investments, right? Putting it in CDs or other more aggressive investments, real estate, whatever it is, right? Trying to make that money work more for you instead of having an excess amount within your business bank account, which can also be a liability as well. Um, and then, of course, always adjusting pricing. Being careful what kind of pricing you kind of lock into. Especially if it's year-long contract or more. Really having a good understanding of your numbers, which is really a big part of it as well. You want to make sure that your pricing is based off of your numbers and your accounting data. Another common thing where it, you may not really realize the impact and maybe the cash leaking out of the company is some of the unexpected delays, right? Are you building in buffers into your pricing? Because things happen, right? Weather, unexpected delays, things come up. You want to actually build that into your estimates. Also, be careful when you're providing discounts. So there's a couple issues with discounts. I think the first being that, do you really want customers that are just going to you for a discount, right? So I think really thinking about more of, okay, how can we sell our service, whether it's install or maintenance, based on the value that we provide, based on the reliability and other factors, right? The other issue with discounts, especially if it's coming off of the price that you've already estimated at, you know, for instance, if you estimate a job at 10,000 and you're going to make a 15% net profit of 1,500, think about it. If you give a 10% discount, that leaves you with a 5% net profit, right? So that's coming right from your bottom line. So be extremely careful what kind of discounts you provide, even when you're bundling services, right? So it's a good strategy, especially if you provide a variety of different services to a homeowner or on the commercial side. But understanding that you don't want one service to be extremely profitable with the other actually losing money, right? What we always recommend is it's okay to not make as much or as high profitability in one division, um, versus another, but we don't recommend having a loss leader, basically meaning losing money in one division to basically support the other. And a common view of that in the green industry is having some of the maintenance to then have the opportunity to have some of the enhancement and install based work. But we know that the market changes, the economy changes, and we want companies to be able to sustain over time in a financially healthy way, right? Um, and also, are you giving yourself a safety net to cover, as I mentioned, all of those costs throughout the year, right? So really really emphasizing pricing. Um, it's a big factor in making sure, because you also want to set yourself up good, especially if you do any sort of P for P or variable pay or bonuses, right? You want to give your team a shot, right? You want to give your team a chance to perform, in regard to that as well. And even when you're looking at recouping all your costs in your estimates, you know, maybe kind of a quick way to look at this is maybe your current hourly rate is $90 an hour, right? You review your financials and you're charging $90 an hour. You feel like you're making, maybe a 15% net profit, but when you look at your numbers and your accounts are reconciled and you look at your financial reports, it shows that you're actually making a 7% net profit. Now, how do you then get to that 15% profit goal, right? It's really that 8% buffer, right? So it needs to increase by 8%. So you can either increase your hourly rate by that amount, or you can think about, okay, what are some things that we can do to kind of still stay competitive in the market in regard to pricing, but improve some of the efficiencies. And my recommendation is price increase is not only the fastest way to improve profitability, um, but there's also more uncertainties because I think everyone would always like to think that, oh, we can increase efficiencies, we can improve productivity in the field, we can do these different things, we can decrease overhead. That it ultimately is going to take time. There's going to be time also involved with just ramping different things up and different processes that need to be changed, training in a different strategy or working on a different kind of work or different area. So take into account and kind of buffering in those times as well. Um, and I also recommend is if you don't want to do it more based on a price increase, based on that goal or that improvement that needs to be made, you need to hold yourself and your team accountable to that. So, for instance, if this company had a 7% net profit and they came up with those goals earlier in the year, at the very least, looking at that on a quarterly basis, and if you're not seeing a change, then you're going to have to change up your strategy, right? If that means doing a little bit of less kind of work in one specific division versus another, or if it means that one of your team members is just not the right fit, or they need to start working on a different kind of project, right? So making those certain moves, or maybe it's even overhead costs, right? You need to hit a certain sales number in order to recoup your overhead. If you're not hitting that sales number, make a change, right? Um, so just, I would definitely recommend, some of those items. Another hidden thing to consider is customer retention. This is a big one, right? Especially for those that provide some of the recurring based services. But even when you look at more of the install based services, you want to leave an impression on them where now your future work can come a lot from referrals, right? And your name could be built in the community, because those are ultimately less marketing dollars that you will need to spend, right? And even if you look at, again, more on those recurring jobs, a company that has a customer attrition of 20% versus another company that has 10%, that can make a significant difference, right? So again, that company that has attrition of double at 20%, they're going to have to spend a lot more on marketing just to get back to that same point of the other company that only had the 10% attrition, right? So having less attrition always puts you in a better position. Not only being able to retain that revenue, but then also being able to allocate those marketing dollars to then acquire new customers and continuing to grow, because that often becomes the bottleneck. Um, with companies that provide some of the recurring services. But I think that it's talked about a lot with the recurring maintenance and lawn care and pest control, stuff like that. But I think you can also think of it in terms of, okay, how many relationships can you retain, even if it's more on the install base side? Really trying to utilize those, as much as you can. So I hope that these points kind of helped you. Again, I think that there's always a lot of things discussed in regard to the profit and loss statement, right? Or some of those items that when you look at your financial statements, it's maybe the things that are relatively easier to understand, or it doesn't take too much digging to kind of look into. So I hope that this kind of sheds some light into some of the things that aren't talked about as much, but to really try to prioritize, because different adjustments, even with some of the items that I had discussed, these are what's going to change, your bottom line net profit, right? These are, some of the things that, I definitely recommend prioritizing. So I hope everyone has a great rest of your year. And most importantly, hope you have a profitable year as well.
Thank you for listening to today's podcast episode. Once again, check out Cycle CPA at cyclecpa.com. Let them know How to Hardscape sent you for money off their bookkeeping, accounting, CFO services there. And I highly suggest you go reach out to them to get that conversation started today. And we look forward to meeting with you next week on the How to Hardscape podcast.